With that, we are ready to move to the next paper of the session, which is titled Compressing Over-the-Counter Markets. It's a paper by Marco De Rico of ESRB and Tarik Roukny, Katholiek University Leuven and MIT. So please, I believe it's Tarik who's presented the paper.
Yes,
yes, please, the floor is yours. Yes, we can hear you and we can see your slides.
All right, great. So thank you so much, everyone. Thank you so much to the selection committee for including our paper in this very exciting program. It's a great pleasure to be here, and I really look forward to any comment or feedback you may have. So this is joint work with Marco De Rico from the European Systemic Risk Board, and basically the story of our paper is the story of a technology, which basically has, and that's what we test and we want to test, has the potential to deeply transform the anatomy and the structure of financial markets, and in particular here, over-the-counter markets. So over-the-counter market, in particular derivatives market, are very important to the economy, but they're also crucial in times of crisis, as we've seen during the last one. One important feature that they have is that they're actually huge. So here we look at their evolution of their size over time, and this is in the orders of hundreds of trillions of dollars. But the second thing that is very specific to them is that they also exhibit large swings in terms of these values from one quarter to the next. In the orders of dozens of trillions of dollars of notional from one quarter to the next. And this becomes even more specific or even more prevalent as we move into some specific segments of those markets. So this is the case for credit default swap markets here, where we plot the same thing and we observe that they had increased a lot between 2004 and 2008, but then they started decreasing quite rapidly from 2008 onwards, starting from 60 trillion worth of notional and ending up today around a little bit less than 10 trillion. And so the starting point of our research question was, what is driving these changes? And in particular, what is driving the reduction in size? And the reason why we believe it's important is because if you only look at this slide, well, maybe one of the obvious answer would be that this is driven mainly by trade activity. And so participants stop trading in those markets or they reduce their trading. And so the policy implication for this is that liquidity has dropped and maybe dealers have stocked up all their inventory capacity, and that's one important conclusion. Instead, what I want to discuss today is an alternative story, and a story which is driven by a technology adoption, which, if hold true, would actually entail the opposite conclusion. That is, liquidity may have increased in those markets because of this reduction in size, and inventory capacity from dealers have actually increased. And so this technology that I keep on referring to has also been pointed out by a few reports and a few indicators. So this is an excerpt from a piece in the Financial Times in 2016, reporting on suggestions by the BIS, which claims that the key driver to the fall in outstanding notional was actually the fact that banks started turning to a new tool called portfolio compression. And so that is the topic of my presentation today, and that is the technology that I've been hinting at since the beginning. So what is portfolio compression? Well, portfolio compression is simply a post-trade technology that aims at reducing gross positions of market participants while maintaining net balances equal. So if you assume that you were to observe such a market where we have here, let's assume that we have contracts traded, CDS contracts traded on the same reference entity with the same maturity, so fully fungible, and we were to observe as a compression service provider, we were being given this information from our clients, and we were to observe this network of contracts. Then we can compute all those gross positions and net position, and then we can compute the market total size. So here would be 45 units by summing up all the trades, which is basically how you would compute the 60 trillion in the CDS market that I showed before. And basically my goal as a service provider, compression service provider, will be to identify ways in which we could rearrange those contracts in order to reduce gross positions while maintaining net balances the same. So in this case, one solution could be, for example, to terminate the contract between B and A and adjust the contracts between B and C and A, such that as a result, the gross position of A, B, and C have been reduced by 5 units, while the net position of everyone have kept the same. And so at the market level now, what we observe is that we've achieved the reduction of the total size by 15 units without economically meaningfully changing anything else in the market. So one important thing to point out here right away is that obviously portfolio compression is a form of multilateral netting, And it contrasts with, let's say, the most traditional form of multilateral netting, that is netting via central clearing counterparties. But by the simple fact that here, in order to achieve this multilateral netting, we did not require the introduction and implementation of a clearinghouse. Right? So here, everything is achieved decentrally, and there is no need to stick a node in the middle of the market, if you will. All right, so how is this technology shaping up the market? So in terms of how much has been eliminated through the system, we have some cues given by market practitioners. So here, this is an amount given by Trioptima, which is the pioneer and leader in the service of compression technology, which claims to have been able to eliminate more than $1.8 quadrillion of notional since they started in 2003. But most specifically, their business started booming and their efficiency started booming after 2008, 2009, and 2010. And according to them and to many other market practitioners, the main reason for the boom in demand for this technology has been driven by the global regulatory reform. In fact, through the new regulatory framework, new capital and collateral requirements have been introduced whose computation is basically including notional from the derivatives market. And so these, from the bank's perspective, this becomes additional cost that they have to bear. And basically now, thanks to portfolio compression, what they're able to do is deleverage their position without requiring any new capital injection or any need of selling any asset. They're basically reducing their gross position without changing their net. And this has become something that has been very demanded from the bank's perspective, given the new cost driven by the novel regulatory framework. From a regulatory perspective, again, the technology has benefited from a global support, both in Europe under the European market infrastructure and in the US under Dodd-Frank. So taking stock of all these elements, it seems like this is a quite important technology that is shaping up a few markets. But at the moment, and especially when we started looking into this technology, there's been quite a limited amount of research looking at the technology itself, but also offering cues as to what would be the systemic implications of a widespread adoption of the technology. And so obviously this is a very open and large question, and we can look and dissect it in many different ways. And because we are having a first stab at it, what I really want to achieve today is shamefully simple. I want to introduce you to some of the fundamentals of the technology. So basically understand under which condition it can take place, but also how much can we actually eliminate from the market if people were to adopt it. And finally, I want to be able to derive some policy implications of this market adoption. All right, so one important thing is that if we are to understand these netting technologies, the first thing we need to understand is the amount of opportunities they actually can address. And so in order to do that, what we need to understand is that if we were able to eliminate something from a market, it means that ex ante this market was exhibiting some kind of redundancy. And so we need to formalize the level of redundancy that is actually eligible for netting or compressing. So that's what I want to showcase with this figure here. So here we have a traditional OTC derivative market where we have dealers in between customers trading. So this is real data mapped from the data collected under the EMIR framework, where it's basically all the same contracts, CDS contract written on the same reference entity with the same maturity as of April 2016. And what I tell you here is that the total size of the market is a pretty small market, is 16 billion euros. And so what we want to understand is how these 16 billion euros gets distributed among different types of participants, and then how much of these 16 billion euros is actually up for compression candidates. So the structure is quite familiar to a lot of people involved in the network literature. So basically we have a core periphery structure where we have customers buying, customers selling, and then we have dealers in between that intermediate between those customers, but those dealers also trade with and amongst each other. And so from a distribution perspective, what we have is that more than 95% of the total size of the market resides in the intra-dealer segment. So we have a highly concentrated market. But then on top of that, when we look at how much of this total size is actually covered by net position, what we find is that on average, 20% of the gross position of dealers is covered by their net. So if you run a quick calculation, it means that 80% of these 95% of those 16 billions are actually up for netting and compression. Right? They are the result of offsetting trades that an efficient netting mechanism could quickly eliminate from the market in one go. So once we have this, let us formalize the concept of redundancy, and we do so with what we call notional excess. So notional excess in a market is going to be the difference between the total gross notional of the market, so the sum of all these notional, and the minimum amount we require in order to satisfy every market participant's net position. So once we have that,
3 minutes, please.
Okay, so once we have that, we find that what is generating this excess is actually the intermediation in the market. And so as soon as we have intermediation in the market, we will have this positive excess and we will be able to compress it. Now we can compress it in many ways according to different participants' individual preferences. So what we do here to simplify the story is we consider a series of benchmarks. So we will have conservative compression, which basically implies here that participants will only accept to reduce or eliminate contracts that they already have, but they will always reject a solution that creates contract with a counterparty that they were not trading before. The non-conservative case, in contrast, does not care about this. Participants are indifferent with their relationships. The only thing they care about is minimizing the gross, and they keep the net position the same. And then the hybrid is a combination of the two, where we just allow for the non-conservative case to happen in the dealer side. And we have a bunch of theoretical results that explain how they can work. But let me move on to the applications and to the data, given the time we have. So we have data here, similar to what I've shown before. So we have all credit derivative, all credit default swap information in Europe as soon as there is one European party involved. And so we use this data in order to construct the top 100 most traded instruments and the related networks to each of those instruments. And once we've established these markets, what we compute for each of those markets is going to be the actual excess levels that they exhibit, and then how efficient all these different approaches can be. And so what we find is that in terms of excess, here it's going to be the ratio between the total excess exhibited in the market and the actual size of the market. We find that on average, and this is pretty stable over time, those markets, those CDS markets that we observe, exhibit more than 75% excess with respect to their total size. So when I was talking about the 60 trillion, when I was talking about the 700 trillion, 70% according to this sample data is in excess, so it's candidate for compression. And then when we apply the compression algorithms that we have and we implement them, so basically here what we do is we assume that everyone participates, basically to really try and have an upper bound as to how much can theoretically be eliminated away from market if everyone was to coordinate on these mechanisms. What we find is that even for the most conservative compression algorithm, which basically, as I said, only aims to reduce or eliminate already existing contracts and does not disrupt the market any further by suggesting new relationships, can eliminate more than 85% of the excess exhibited by markets. And this goes even further as you relax more the constraints. So let me summarize and conclude here. Over-the-counter markets are important for the economy. They're also very huge, and they have a natural tendency to generate large excesses because of the intermediation nature that they have. We find here that on average, they have more than 75% of their total notional is actually in excess, so resulting from redundant trades. Excess can then be removed by portfolio compression, for which the private demand so far has been driven by the regulatory cost associated with excess. And this demand on its own can actually explain away the large reduction in size in CDS markets and other markets. And the reason for this is because of the tightly knit structure of these over-the-counter market, where much of the notional resides in the intradealer segment, and these intradealer segment are tightly knit, so there's a lot of connections between them, which even for the most conservative compression, so even just eliminating trades results in very efficient elimination of excess, as we see here. On average, more than 80% can be done. And so the final information that I want to shoot out here is we believe these results have important policy implications. First, because the adoption of this technology can actually distort aggregate assessment, as I've mentioned, for liquidity, but also because it can redistribute risk among the participants, especially from dealers away to customers, relatively speaking, and also because it entails different incentives for participants to engage in the technology. So there might be a need for harmonizing participation among banks and non-banks, which which face different types of regulatory constraints. And finally, we also believe that there might be room here for a utility beyond the private demand, and whereas this netting technology could also be used in terms of systemic risk as a systemic risk management tool. All right, sorry for rushing up. I hope everything was clear, but the paper is available and I look forward to your comments and questions.
Thank you. Thank you very much, Tarik. This was a very, very interesting presentation. So we have Michele Zarpellon from EBA, who is going to discuss the paper.
Good afternoon. Just let me share it. Okay. It should be on, right? So thank you to my colleague for organizing the workshop. Of course, thank you to the author for providing this just very nice paper. I did enjoy it very much in reading it. A couple of preliminary remarks before to start. The opinion here, just my personal opinion, I'm not EBA position on compression, and also I'm very much supportive of the compression process and everything. So the challenge here just for the sake of the discussion of the paper. So I'm going to try to challenge a little bit the authors in a couple of concepts that they did it in they supported in the paper. The first one is the use of efficiencies analysis, and the other one is going to be the use of exposures. So I'd like for them to provide a little bit more of an in-depth of this. I understand the times is not much, but let's try to have a look a little bit of what they did. So in terms to measuring the efficiency, they use they just consider all the counterparty as if they were the same. And they come up with the fact that having netting opportunities arise more when there are less conservative constraint in the compression. That's that was a given since the beginning to me. So to me, it is how they use this concept of excess indicator, and they just postulate that all the counterparties have the same risk, and everybody participate in the same exercise. And this is again a little bit of a stretch in the overall try to understand how much indeed excess there is in the market. So indeed they actually in the paper provide these 4 cases: conservative, non-conservative, hybrid, and compressions case. And the actual, they are all, of course, theoretically fine, but it is just, to me, very difficult to see in reality the non-compressive case applied, and also the hybrid one is very stretched in the sense that with the non-conservatives, you just assume that everybody is participate to the compression exercise, and they're happy to see the position changed. So also the counterparty can change. But also with the hybrid, so the hybrid is between the conservative and the non-conservative. And even if here the dealer, again, they would be happy to see the counterparty change no matter what the counterparty is, as long as the notional amount at the end is lower than the beginning. So based on this assumption, the authors come up with a ranking order that, of course, put at the top the case of the non-conservative case, and then go down with the hybrid, the non-conservative, and the last one is the bilateral compression. So in terms of efficiency, I have a few issues that I'd like for them to give out a little bit. So the ranking, it was since they begin expected that was the ranking. This is not a surprise because you just reduce, you just put more boundaries in the function that you need to minimize. So it's clear that you are less room for minimization. Then would not be the case try to imagine a more realistic case, because I can see the conservative case where everybody would be pleased to see the position diminished. But when you go even with the hybrid one, so at that point, every dealer can just see each other change without any. I see this very, very difficult. I don't see the dealer participate in a massive exercise where everybody can change position as long as it's diminished. So to me, this is the case that say, okay, but don't we risk that given this notion of efficiency, don't we give a false expectation on what it is really achievable by the compression? And this is the first part of the efficiency that the second part, Tarik was not able to go too much into detail because the paper is very articulated. But it was the analysis on CCP. At some point, you say that the effect on the market access for CCP is quite ambiguous. This is my second point: is the use of the notion of exposure that you have. It looks like the driver here is just decreasing the notion of exposure, but exposure is not the risk. At the end, the CCP is there just to decrease the systemic risk, and the systemic risk is increased by pooling the risk. That's clear. Pooling the notional, clearing the notional, but also diminish the default probability, because changing the counterparty then you decrease the overall systemic risk, because the CCP has by definition much lower risk with respect to the dealer. And also the part of the analysis that you make where you introduce a lot of CCP just to show that this decrease even further the efficiency of the CCP. Actually, I don't see that much, because yes, indeed, we have different CCP in Europe, for instance, but there is not a great competition in there, just because many of them, they are really focused on some specific aspect. So many cases, there is no a great overlap. So it's a quasi monopolistic market. So and this is what I want to say just in terms of exposure. So just to give a little bit of feedback from the author in the fact that they just measure the exposure in terms of notional, but they don't take into consideration the overall measure of risk. And indeed, this is what CCP does, which is increases, yes, the exposure, but decreasing the risk just because of the lower level of default probability. I would have another couple of questions if there are none from the public, but I'd like to for the author to give opportunity to provide some response on those. So thank you.
Thank you, Michele. Tarik, you want to pick up some points?
Yes, sure. So thank you so much, Michele. I appreciate your perspective, and I appreciate also how you highlight some of the points we basically left off of it your work. So one thing that I think, what I take the most important comment you make is that the important variable we use for the optimization dimension may be subject to may not be complete. And I fully agree with that. However, the reason why we focus so much on notional is because this is what is driving the demand from a market participant's perspective, because notional is what is used in the leverage ratios in the capital requirement computation. So risk on its own, and that I take from the founder of Trioptima, Per Soyberg, risk on its own did not drive the demand for the technology. So the technology was there since 2003, and according to himself, it was seen by banks as good housekeeping. So everything that we have to say about the risk minimization of the technology, its capacity to reduce the amount of line item, to increase transparency, etc., is correct, but this was not driving the demand. What really kickstarted the demand was the inclusion of notional in derivative, in OTC derivative, in the computation of capital requirements. So we believe that still it is realistic to focus, at the first order on participants seeking to reduce this dimension. And so that's why we focus so much on it. So that is, I think, important to establish really this notion of excess. And I think notional, in any case, is a variable that is very important also for regulators, and they do focus a lot on this, in particular in times of crisis, etc. So that's also why I started the presentation with the exhibit of the size of those markets in terms of gross notion. And so that also connects with your comment on the CCPs, for which you're completely right. Indeed, CCPs from a credit risk perspective have a profile that cannot be compared to any other counterparty. And that is fully acknowledged. And I think a model that would claim to have some direct implication in terms of financial stability would need to include that, and we plan to do that in the future. But at this stage, what we need to, or what we wanted to do, was to make clear that we are measuring things at the same level. And if we are to compare portfolio compression with the netting that comes via CCPs, we need to use the same basis, and here what we use as a basis is going to be the success. As to what you're saying, for which you're right, CCP, there is, and I think this is an open question, and we should keep it open, is what is best, to have one CCP per asset, or should we promote competition for CCPs? And so what we think we bring in on the table here is, whereas CCPs have these network effects which make them natural monopolies, most of those network effects actually arise from their netting opportunities. And so what we show in the paper is that obviously you will lose netting opportunities as you increase the number of CCPs in the market. That is completely correct. But as soon as you allow for this portfolio compression to come on top of it, you actually recover the efficiency of one single CCP. And so what we believe this can open the door for is, by allowing this interoperability, then you may hope for example, more competition among CCPs, which, you know, should at least be discussed in the context of the central clearing mandate. These, I think, were the most important things I wanted to address. Maybe one last thing. I fully agree with you. So the non-conservative compression is used as a benchmark. It's basically used to showcase theoretically and empirically that what will be limiting, so that if you allow people to, if people become indifferent with respect to their original positions, basically if their need to compress out their position becomes the most important need beyond their relationship trading, so assume, for example, in times of crisis, what you really need to do is reduce your position or eliminate some of the exposure, then they can always achieve full excess elimination. I think that's why it's useful, but it's definitely, we're not implying that this is actually taking place in practice. We're much more relying on the conservative compression dimension, for which we believe what is interesting is when we bring into data and we see that even the conservative compression can already achieve 85% of efficiency in the market. Thank you very much.